Hello friends, today we are going to discuss about accounting equations. This is one of the critical part to understand before we start learning journal entries. So let's start understanding what is the meaning of accounting equation. The recording of business transaction is entirely based on accounting equations. Accounting equation is based on dual concept of accounting. So this is the concept what we studied in the previous video, and dual concept says that there is always a debit and credit. For every debit and credit there is an equal credit, correct? So dual concept states that every debit must have a corresponding credit and every credit must have a debit. The total of the debit side must be equal to total of credit side. Accounting equation states that any point of time, the asset of a business must be equal to the total of owner's equity, that is capital and outsider claims or liabilities, you can say. Okay. So the equation what it talks about is assets. The total assets what you will be having is equal to liabilities plus capital. Okay. Now the same formula, if you want to derive capital, then it is assets minus liabilities. Similarly, if you want liabilities, then it is asset minus capital. So before we start the accounting equation, let's try to understand what is balance sheet. So by understanding the balance sheet, we can frame the accounting equations, correct? As we saw in the previous slide, assets equal to liability plus capital. So let's try to understand how in balance sheet we can derive that formula. Okay, so we need not mug up the formulas, we'll try to derive the logics behind this formula. Okay, so if you see in a balance sheet, this is a draft balance sheet. If you see here, we have liabilities, capital, loan from bank, payable to suppliers, provision for expenses. On the other side, you can find assets, plant and machinery, furniture, received from customer if you sold any item on credit, and then the cash in hand. Okay. So what is the meaning of this liabilities? Okay. See, liabilities is generally like source of fund. That means it is by cash or non-cash. This is the maximum what the company has resources to spend, correct? So spend can be on expenses, spend can be on the assets. Okay. So cash item can be capital invested by the owner or loan from the bank. These are all cash item what you get it as from the business side. Non-cash item can be payable to suppliers for goods purchased on credit. So if you have got any material or any goods on credit, then the liability what you have to pay to the supplier will be reflected there. There can be item like provision accrued for expenses or outstanding expenses where you have not paid by cash, but the expense belongs to that particular month or year. You need to accrue it, correct? Now coming to the asset side, it is utilization of fund. So liability is your sources of fund and asset is your utilization of fund. How the funds can be utilized? It can be purchase of fixed assets, service goods sold to customer on credit, and if any unutilized fund is there, then that remains in cash in hand. So these are all assets, correct? Now utilization of fund can't be more than the source of fund. It can be always equal to source of fund. Okay. So assets equal to liabilities. So if you see here in our given example, 1,75,000 you have liabilities and the 1,75,000 is an asset. Always the liability and asset will be equal. It should tally. So from this particular balance sheet, if we try to derive only assets, what is assets? Then it is equal to liabilities plus capital. So liabilities here, if you see loan from bank, payable to supplier, provision for expenses, anything apart from capital reported under the liability is liabilities, and capital is generally the investment done by the owner or shareholders, hence it is shown as separately. So asset equal to liabilities and capital. So we'll try to understand the accounting equation through an example. So we'll do a business case where we'll have different type of transactions and see that how the accounting equation is derived, how it is calculated, how it is reported in the balance sheet. Okay. So let's discuss on this particular example. First, commencement of business. So Mr. Ramesh started his business with capital rupees 2 lakh. Okay. So what accounting equation we have learned? Assets equal to capital per liabilities. So this is where we will be applying in each one of the example or business transactions. As Ramesh has invested rupees 2 lakh in the business received cash of rupees 2 lakh, which is asset for the business. Correct. So here if you see the accounting equation, the asset what I have is 2 lakh rupees, that is the cash, equal to 2 lakh rupees is the capital invested by Ramesh, and on this particular transaction there is no liability. So nil is the liability. Okay. So if I prepare the balance sheet on this particular day, then I have a capital of 2 lakh rupees and cash of 2 lakh rupees. So I have an asset of 2 lakh and capital of 2 lakh without any liability. Now coming to the second transaction, purchase of an asset for cash. So Ramesh purchased furniture of rupees 20,000 rupees. So in the previous slide we talked about that he invested 2 lakh rupees as capital. Then after receiving the money, the business has invested or purchased a furniture for rupees 20,000. So let's see how the accounting equation will work. So accounting equation remains same, asset equal to capital plus liabilities. As Ramesh has purchased furniture at the rate of 20,000 rupees, there are two impacts for the business. What are the two impacts happening? One is addition of assets of rupees 20,000 rupees because there was nothing at the time of startup. So you are getting a furniture at the rate of 20,000 rupees. And there will be reduction of asset, that is 20,000 rupees cash. So the 2 lakh rupees what was invested by Mr. Ramesh, that will come down to 1,80,000 rupees. And in addition to this 1,80,000 rupees, the business will have furniture of rupees 20,000 rupees. So if you see the accounting equation here, asset equal to capital plus liabilities. So the cash what the business will have is 1,80,000 rupees plus 20,000 rupees furniture equal to 2 lakh, which is equal to 2 lakh rupees invested by Mr. Ramesh, and there is no liability. Correct. So on this date, if you prepare the balance sheet, you can see capital reported by the business is 2 lakh rupees, and the asset you can see assets pertaining to furniture is 20,000 rupees, and cash is 1,80,000, and the liability and the assets are tallying with 2 lakh rupees. Now coming to the third transaction, purchase of asset on credit. Correct. So in the previous slide we saw that asset was purchased on cash. In this particular example, Ramesh purchased computer for rupees 40,000 on credit from ABC Limited. So ABC Limited is the supplier and the cost of the computers is rupees 40,000 rupees. So our accounting equation remains same, assets equal to capital plus liabilities. As Ramesh has purchased computers at the rate of 40,000, there are two impacts for the business. Okay. Addition of assets of computer rupees 40,000, it is similar to what we have seen in the previous case, but here the cash payment is not happening, correct, because it is on credit. What is the second impact? Addition or increase of liability to suppliers of rupees 40,000. So the liability will go up or liability will increase by 40,000 rupees because you have to pay to ABC Limited, correct. There is no cash payment, hence no reduction in assets. It is not similar to the previous case. Okay. So now when we prepare the account equation, the cash remains 1,80,000 because you have not paid anything in this transaction. 20,000 rupees furniture is there, 40,000 rupees computer which got added, equal to 2 lakh rupees of capital which is invested by Ramesh, and 40,000 rupees is the liability what we are going to pay to ABC Limited. So when you prepare the balance sheet on this date, okay, you can see capital of 2 lakh is there. Okay. Payable to ABC Limited is 40,000 because this is the liability which is created as it is not paid. Computers were purchased on credit. On the other side, if you see assets, cash you have 1,80,000, furniture 20,000 rupees, and computer 40,000. So in both sides, if you see, add up, we have 2,40,000 rupees. Coming to the fourth transaction, payment to ABC Limited for computers. So in the previous slide, we recorded that the computers were purchased on credit. And after a few days, when the payment is made, we need to see that how it is going to impact the balance sheet and accounting equation. So Ramesh paid rupees 40,000 to ABC for computers purchased on credit. Correct. So accounting equation remains same, assets equal to capital plus liabilities. As Ramesh has made payment to the supplier, there are two impacts for the business. Correct. Reduce of liability of rupees 40,000. So in the previous slide, we saw that we have created a payable to ABC Limited of 40,000 rupees. That will square off now because you are making the payment to the supplier. So how it will square off? What will go out from the company? It is a cash. So reduction of a cash of 40,000 rupees. So your asset will come down by 40,000 rupees. So the accounting equation at this stage, if you see here, rupees 1,40,000 rupees cash plus 20,000 rupees furniture plus 40,000 rupees of computers equal to 2 lakh rupees of capital. Correct. And there is no liability outstanding. So compared to the previous example, in this accounting equation, the 40,000 rupees is getting reduced only from the asset which is cash. Now if I prepare the balance sheet on this particular date, then the capital remains same 2 lakh rupees, and on the asset side we have cash 1,40,000, furniture 20,000 rupees, computer 40,000 rupees, and your assets and liability in total is 2 lakh rupees each. Coming to the next example, salary payment to employees. So this is one example where we have taken payment towards employees, which is expense, not an asset. So Ramesh paid salary to employees rupees 10,000 rupees. Accounting equation again remains same, asset equal to capital plus liabilities. As Ramesh has made payment towards salary, there are two impacts for the business. Expense which is loss to the business will reduce the capital. Okay, so it is very clear, any expense or loss will reduce the capital, any gain from the business will increase the capital. Okay, and the second impact is reduce of assets, cash paid to the employees. Okay, so accounting equation at this stage, if you see, rupees 1,30,000 rupees cash, because 10,000 is paid to the employees, so cash is reduced. Furniture remains same, 20,000 rupees. Computer remains same, 40,000 rupees. Capital reduced by 10,000 rupees because the expenses paid is a loss for the business. There is no earning on the other side. Hence, the capital became 1,90,000. Liability is nil because we have paid to ABC Limited in the previous slide. So the balance sheet on this particular date, if you see, capital is 1,90,000. Loss or expense towards salary 10,000 has been reduced from the capital. And on the asset side, cash is 1,30,000 rupees, 10,000 reduced compared to the previous transaction. Furniture 20,000, computer 20,000. Now if you see the asset and liability total, it is 1,90,000 rupees. Coming to the next transaction, purchase of stocks for cash. Okay, now this business has to buy some inventory or stock so that it can sell in profit and earn profit from the business, right? So purchase of stocks for cash. Ramesh purchased stock of rupees 50,000 in cash. Here the accounting equation remains same, asset is equal to capital plus liabilities. As Ramesh has purchased stock at the rate of 50,000, there are two impacts for the business. Okay, addition of assets of rupees 50,000 rupees. Stock is always an asset for the company because you will be selling in future and earn money out of that. Second, reduction of asset 50,000, where the cash will be moving out from the business because you are buying the stock. Okay, so if you see the accounting equation here, cash is 80,000 rupees because 50,000 is getting reduced from 1,30,000 compared to the previous slide, and 20,000 of furniture and computer 40,000 remains same. 50,000 stock get added to the balance sheet, equal to 1,90,000 is the capital. Last time we saw that from 2,10,000 towards the salary is reduced, so it is 1,90,000. And the balance sheet on this date, if you see, capital 1,90,000, and on the asset side there is an addition of stock of 50,000 rupees and cash has reduced by 50,000 rupees, so it is 80,000. In total, the balance sheet is carrying an asset, a total asset of 1,90,000 and capital of 1,90,000. Coming to the next business transaction, sold stocks for cash at profit. So in the previous example, we saw that the stocks were purchased. Now the business is selling stock. So Ramesh sold stock of rupees 20,000 at rupees 40,000. Profit earned is 20,000 rupees. So 100% profit Ramesh has charged on the customer, and the profit earned is 20,000 rupees. So here also accounting equation remains same, assets equal to capital plus liabilities. As Ramesh has sold stock at profit, there are three impacts for the business. Okay, because there is a profit element in this particular transaction, so there will be three impacts. What are the three impacts? A, reduction of assets, 20,000 rupees stock, because stock what we purchase is 50,000 rupees. Now we have reduced it by 20,000 rupees. Additions of assets of rupees 40,000 because the customer is going to pay you including the profit, that is 40,000 rupees cash. So your cash will go up by 40,000 rupees. Profit earned is 20,000 rupees will be added to the capital. So in the time at the time of salary example, I explained that any type of loss or expenses will be deducted from the capital. Any type of income and gain will be added to the capital. So in this particular case, we have profit, so the capital will go up by 20,000 rupees. So coming to the accounting equation here, 1,20,000 is the cash because the cash is increased by 40,000 rupees. In the previous slide, we saw the cash balance was 80,000. 80,000 plus 40,000 is 1,20,000. Furniture 20,000 remains same. Computer 40,000 remains same. 30,000 is the stock balance now because from 50,000 we have sold 20,000. And the capital, if you see, it has increased by 20,000 rupees. In the previous slide, it was 1,90,000 plus 20,000 now, so it is 2,10,000. So if we prepare the balance sheet on this particular date, the capital is 2,10,000 rupees. Whereas in the asset side, the cash increased by 40,000, hence 1,20,000. Furniture remains same, computer remains same, stock reduced by 20,000 rupees, and the total of assets on this date is 2,10,000, which is equal to the capital of 2,10,000 rupees. So this is the end of the session. Hope you understood the accounting equation. and we'll get more clarity when we'll understand journal entries. Okay, so thank you for watching this video. Please subscribe the channel and like it and share with your friends so everybody understands how to frame accounting equations with a short period of time. Thank you.